Today we are talking about how long-term capital gains affect the taxation of Social Security benefits. This isn't well understood and can pose a tax trap to retirees. That's what we're talking about. Let's get going. I've worked with a lot of people that spent their career at large publicly traded companies, during which time they accumulated a large amount of company stock. One of my go-to retirement planning strategies is working with folks doing proactive tax planning to manage their income down in an effort to gradually sell that stock off at a 0% federal tax rate. Now, of course, you're able to do that because long-term capital gains get preferential treatment in the tax code. Now, let me just throw the brackets for tax year 2024 up on the screen for reference, because we're going to look at a couple of examples in a minute, and some of these numbers are going to be relevant. Now, again, these are the brackets for long-term capital gains. In this first column on the left, you have the income thresholds for individual tax filers. On the right, you have the thresholds for joint filers, with the associated tax rates in the middle. Now, obviously, selling appreciated stock and paying a 0% federal income tax is an attractive opportunity if it's there for you. And again, with retirees, it often is, because retirees, in many cases, have the ability to manage how much taxable income they create in a given year. And this is what I spend a ton of time working with my clients on. Now, taking capital gains at this 0% tax rate, this first rate threshold here, is a relatively straightforward process as long as an individual is not drawing Social Security. Okay, basically, as long as one's combined taxable income from all sources, including the capital gain, is under $94,050 for joint filers or $47,025 for individual filers, as long as you're under that, pretty easy approach. But once Social Security begins, things get more complicated, and this has to do with the way in which the taxation of Social Security is calculated. Now, when it comes to the taxation of Social Security, practically speaking, all you really need to know is if your income is low enough, you don't pay any federal income tax on your benefits. But as your income starts to increase, including from capital gains, some of your benefits will become taxable all the way up to a maximum of 85%. Now, think about what I just said. As your income rises, including from capital gains, more of your Social Security benefits will be subject to tax. Herein lies the tax trap that we're talking about today. What frequently occurs with people that are in retirement that have very low taxable income, their only income maybe is Social Security, they think, hey, I'm going to take a capital gain because I can do so at 0%. But what they don't realize is the act of taking a capital gain will increase their income enough to start pushing their Social Security into tax territory. And if the capital gain Social Security combination is enough, they might even end up paying taxes on some or all of the capital gain. We're going to see that more in the examples in a moment. Now, one last thing before we jump into a couple of examples, I want to share with you a retirement resource that I custom built. This is downloadable on my website, and I'll make sure I link to that in the description if you're watching on YouTube. Essentially, what this is a kind of a cheat sheet or shortcut in helping people understand how much of their Social Security benefits are going to be subject to tax, depending on the different combinations of income that they have. Now, let me just briefly show you how you read this worksheet. There's two tables depending on your tax filing status. Obviously, the top is for married filers. The bottom is for individual or single filers. We'll just focus here on the top one. What you need to do is figure out what your combined Social Security benefits are between you and your spouse. So, for example, if your Social Security benefits are combined around $40,000 for tax year 2024, then you want to think about how much other income do you have. And this is income from all sources, whether it's interest income, capital gains, taxable income coming out of a IRA or a 401k. And you want to reference that in this first column here. For example, let's assume that our only sources of income in 2024 are going to be $40,000 of combined Social Security benefits, plus we're going to take a capital gain that's going to amount to about $12,000. Well, we can cross-reference here 40,000 and 12. What this table tells us is 0% or none of our Social Security benefits are going to be subject to tax with that combination of income. But what I'm illustrating in the table is as your other sources of income rise, the amount of your Social Security that's subject to tax starts to increase. And as you can see, once the combination is high enough down here, 85% of your Social Security benefits, which is the maximum, can be subject to taxation. Now finally, let me show you a couple of hypothetical examples, and I'm going to show you how these would actually flow through a tax return. So let's just start simple. Let's imagine a 64-year-old couple, Ted and Kelly. Their only source of income in 2024 was a combined $60,000 of Social Security benefits. So if we look up at the screen, here's their tax return. The only thing that's going to be on it is some Social Security down here on line 6A. So here's the gross amount, $60,000, but most importantly, here's how the tax software is going to calculate the taxable amount. Well, it's zero because their combination of income is low enough so that none of their Social Security benefits are going to be subject to tax. So that's why we have all zeros here. Next, let me show you how layering on some additional income, specifically capital gains, changes the numbers. Now, let's change the numbers by adding a significant long-term capital gain, and I want to illustrate to you how people can end up with an unexpected tax surprise if they don't realize how other income, including capital gains, affects the taxation of Social Security. So first, again, let's just re-reference the tax table for capital gains in 2024. Our hypothetical example here, we're looking at some joint filers. Again, as we discussed, as long as taxable income, remember that phrase, I'm going to reference back to that in a moment, is under $94,050, the tax rate for capital gains is 0%. All right, now our hypothetical couple, Ted and Kelly, might be thinking to themselves, hey, well, our only other income is Social Security, and last year we didn't pay any federal income tax, so we can take a big capital gain and pay no income tax in total. So let's just say, for example, Ted and Kelly decide to take a $90,000 capital gain. Let's see how that actually plays through on their tax return. Now, here is our adjusted 1040, which includes that $90,000 long-term capital gain. And I want to show you how the numbers change. Remember, in the table we just looked at, as long as our combined taxable income is below $94,050, we pay no income tax on our capital gain. Now, we took a $90,000 capital gain. However, remember, taxable income is a combined number. It includes all sources of income. So if we look at the tax return, let me show you the bottom line first. Here's our taxable income. It amounts now to $111,800. If you're scratching your head, my capital gain was only $90,000. How did I end up here? Well, the answer is your capital gain is pushing your Social Security into taxable territory, rather. Again, here's those Social Security benefits, $60,000, but now 85% of those, or $51,000, are hitting your tax return as taxable income, or are going to be included in that calculation. So the way the math works out is we have our taxable Social Security benefits. There's the capital gain for $90,000. We have to add these two up to get our gross income. Now, we do get deductions. In this case, we're illustrating the standard deduction. But that's not enough to bring our income all the way down. So the combined taxable income amount, of course, is $141 minus the standard deduction, ends us up with $111,800. So what I'm trying to illustrate here is how someone who thought a $90,000 long-term capital gain would be completely tax-free ends up being partially taxable because of the way in which other income, including capital gains, interplays with the taxation of Social Security benefits. All right, we really got into the details on this one. The bottom line is if you are someone who is drawing Social Security but you're not paying any federal income tax. If you start taking some capital gains, at some point they're going to push your benefits into taxable territory. If that's what you're trying to avoid, you really need to dial the numbers in carefully. And frankly, this is where software can really come in handy. If you don't have access to tax software, look, it can make some sense to pay someone hundreds of dollars to do this calculation in an effort to save you thousands of dollars in income taxes. But if you're a true DIYer, there's some free calculators on the internet. I also mentioned that free resource, which you can download from my website, showing you the different combinations of income and so forth. So anyway, I hope this one was helpful. If you got any questions, drop those in the comment section. I appreciate you watching. I hope we'll see you in the next one.